So I think the headline announcement for companies has got to be the cut in the main rate of corporation tax to 20% from 1st of April 2015. So what that means is in 2 years' time, all companies will be paying 20% tax, regardless of the size of their profits. And apparently that's the first time it's happened since 1973, which is before even I started work. So before we get to 2015, small companies with profits of less than 300,000 will continue to pay the 20%, so it's no change for them. Main rate of corporation tax, which applies for profits above 1.5 million, will be 23% from 1st of April 13, then 21% the following year, and then we go down to the 20%. Marginal tax rate, which applies to profits between 1.5 million and 300,000, that will be 23.75% from this April, 21.25% from April 14, and then effectively it disappears because everyone will be paying the 20%. What the reducing tax rates do mean, of course, is that there will be less relief for expenses. So it might be worth looking at whether it's worthwhile advancing any revenue expense into one accounting period rather than letting it fall into the next accounting period, and thereby securing a higher rate of tax relief. Another effect of the reducing tax rates is that now it's always more tax efficient to pay dividends rather than salary. I won't actually go through all the detail on this example, but it just shows the position if a dividend was paid rather than a salary of 45,000. And you can see the saving there in bold, over £7,000. And if we're talking about £100,000 salary or dividend, then the saving is over £16,000. So if you do have employee shareholders, then do look at their overall package and the profit extraction and make sure that it's most tax efficient for your particular circumstances. Another piece of good news, annual investment allowance. This gives 100% tax relief for the cost of qualifying plant and machinery up to a specified limit. And ships are now included, which is why we've got the picture of a ship there. I don't suppose the tax relief is going to go too much towards the cost of that sort of ship, but there we are. So the specified limit is going to be increased to 250,000, or has been increased, I should say, to 250,000 from the 1st of January 13. So we've had a range of limits even over the last 12 months. We started off until the 1st of April 12 with a 100,000 limit, then it went down to 25,000, now it's gone back to 250,000 from 1st of January, and then in 2 years' time, 1st of January 15, it'll go back down to 25,000. So if you've got a December 13 year end, you know where you are. You've got 250,000 as your upper limit. But if you have any other year end, then it isn't quite so straightforward because the limits have to be apportioned over your accounting period. So if you've got 30th of June 13 year end, for example, then you apportion the 25,000 that applied for the first half of your accounting period, and you take half of the 250,000 which applied for the last 6 months of your accounting period. So you've got a limit of 137,500. But it isn't quite as simple as that even, because depending on when you actually incur your expenditure, you may not get tax relief in full, even though you've only spent the 137,500. So it is worth making sure you understand or take advice on what your limit is and when expenditure can be incurred in order to get full relief. Again, it can be the case that bringing forward expenditure into one accounting period will allow you to gain full relief, or conversely, it might be better to defer it into the beginning of the next accounting period. And I'd just like to mention very briefly enhanced capital allowances, which give 100% tax relief to energy efficient plant and machinery. And that's being extended for another 5 years. What's particularly good about this tax relief is that if the allowances create a loss, then you can surrender that loss to the revenue for a cash payment of 19% of the loss. So if you're incurring plant and machinery and you've used up all of your annual investment allowance, or maybe you're a loss-making company, then it is a good idea to check whether the equipment you're buying qualifies for this particular relief. And if it doesn't, is there a similar piece of plant perhaps that would qualify for this relief? Moving on to research and development, there's going to be a new tax relief introduced from 1st of April 13, an above-the-line tax credit. It will, however, be optional until 1st of April 16. At that point, it becomes mandatory. And the new relief applies to large companies or to small SMEs who have to claim R&D tax relief under the large company scheme. So maybe they're subcontractors or receive subsidies for the work. The R&D expenditure is calculated in exactly the same way as it always has been, but instead of getting a 30% additional deduction in calculating taxable profits, there's a 10% tax credit payable. That tax credit gets set against the corporation tax for that accounting period. And if there isn't sufficient corporation tax due, then there can be a repayment from the revenue, net of mainstream corporation tax. Although that repayment will be limited to the amount of PAYE and NI of the staff incurred in R&D. So if you are a loss-making company and you're claiming under this scheme, or could have claimed under this scheme, it may be that you haven't bothered before, because if it was only increasing your losses, then it perhaps wasn't worthwhile. Maybe now is the time to reappraise that, because you can now, for the first time, get an actual repayment from the revenue. And for companies of all size, if you are carrying out R&D, then you're probably developing ideas that could be patented. So don't forget that the new patent box regime comes into effect from the 1st of April 13, although it will be phased in over a 4-year period. And what that means is that income from patents or from products incorporating patents that you've developed will be subject to only a 10% tax rate. Very good news also on Enterprise Management Incentive, or EMIs, as they tend to be referred to. And this is a government-improved scheme whereby employees are granted share options to acquire shares in their employer company. So for shares that are acquired after 6th of April 12 and sold after 6th of April 13, the ownership period for entrepreneurs relief is being taken from the date that the options were granted. So what that means in practice is that for options that are granted now, provided there's at least 12 months from when the options were granted to when the shares were actually sold, the employee is likely to only pay 10% tax on all the profits they make on those shares. So this already was a good scheme, and we've implemented a lot of them for our clients already. So if you do have key staff who don't have EMIs, then now's perhaps the time to relook at this scheme, particularly I think if the company is likely to be sold in the next 10 years. There was also quite an interesting comment in the paperwork that came with the budget that referred to some new reliefs coming in 2014 for certain MBOs or for employees acquiring indirect interests in their company. So I think that's potentially very interesting. So we'll be keeping a close eye on that. I haven't actually seen any detail yet, so I don't know how it's going to operate in practice. Disincorporation relief. This is a new relief coming in from the 1st of April for a starting period of 5 years. When a company is wound up, the company is deemed to have disposed of all of its assets, and then it has to pay tax on those profits that are deemed to have been realised. When the assets are then passed out to the shareholders on the winding up, then they have to pay tax as well. And what this tax relief does is effectively do away with that middle tax charge in the company, provided that it disapplies the charge to land and property, but it'll only apply where the market value of land and property is less than 100,000. So we're looking at small scale relief here. Might be helpful in the right circumstances. No budget is complete, of course, without anti-avoidance, and this one's no exception. Although ironically, on the international arena, because of action being taken by the EU, the government have had to actually relax some of the legislation that did apply to companies trying to move their residents from the UK to another member state. There's some anti-avoidance provisions around deductions for employee share acquisitions, losses following a change of ownership, or group relief where profits are being imputed under the controlled foreign company rules. Those are all quite technical rules, I think, to block perceived loopholes, and they're probably not going to have that much impact on us. The one anti-avoidance rule that I think will have more wide-ranging impact is the bottom one, which I've sort of highlighted with a bit of a gap there. Where a close company makes a loan to its shareholder, then it's required to make a deposit with a revenue of 25% of that loan, unless the loan is repaid by the shareholder within 9 months of the year end. And the revenue think that what a lot of people are doing is repaying their loan to the company just before 9 months after the year end. And then lo and behold, we get to a couple of days later and the company makes a new loan again to them. So with immediate effect, that isn't going to be any good anymore where the loan is at least £5,000 and the company makes a new loan back within 30 days of the shareholder repaying the original one. So in those circumstances, it'll be regarded as one loan continuing throughout. And it gets even more interesting if the loan's 15,000, because in that case, the revenue will say were there any intentions when that loan was repaid by the shareholder for the company to make a new loan. And if in fact it does subsequently make a new loan, then exactly the same thing's going to happen. The loans will be regarded as the same one, and that 25% deposit will have to be paid over. So that's quite an interesting arena to be getting into of what people's intentions might be. To end on a more positive note, I'd just like to mention that there are 3 new tax relief for the creative sector. They apply to companies involved in the production of video games, animation or high-end TV programmes. And the relief's given as an extra deduction in calculating taxable profits. And the good thing about this relief, again, is that if this extra deduction creates a loss, then the loss can be surrendered to the revenue for a cash payment of 25%. So if you are in this particular industry, or the industry group, it's obviously very good news. So in summary, I think it's good news for tax rates, or at least everyone other than small companies who are already paying the 20%. Good news in that some existing reliefs have been retained or extended, possibly not so good for people trying to avoid tax.